GCC central banks raised interest rates after the U.S. Federal Reserve announced its largest hike since 1994 overnight. And we're joined by Senior Director at S&P, Dr. Mohammed Damak. Thanks so much for being with us today, Doctor. Now, the UAE and Bahrain, they matched the 75 basis point hike. The Saudi central bank didn't move in line with the Fed. What impact will the Fed's interest rate hike and the subsequent GCC central bank rate hikes really have on the GCC banking sector?
Thank you very much for having me. I think the impact is clearly positive. The top 45 banks reported numbers that show that for every 100 basis point increase in rate, the bottom line increases by around 13%. While this reflects a static view of the balance sheet at year-end 2021, it assumes also that everything remains equal, which is generally not the case. But it shows clearly the direction of travel. We expect the banks in the GCC to adopt a pragmatic approach. They would probably refrain from increasing the rates whenever this could push their clients to financial difficulties. And also, we expect to see some migration of the deposits from the non-interest bearing to interest bearing instruments.
What would you say the impact has been of the GCC interest rate hikes that have already occurred earlier in the year, and have they even had a significant or a measurable impact on economies here?
Right. I think it's a bit early to take stock of the impact, but we think that we will see some of it in the bank's disclosure in the first half of 2022. But clearly, again, the direction of travel is positive. For every 100 basis point movement upward in the rates, the bottom line of the banks is expected to increase by around 13%. It might be less than 13%, but clearly the direction of travel is positive.
And moving beyond the GCC and the broader MENA region, which emerging markets are really especially vulnerable to rate hikes and changes in global liquidity?
Right. I think two countries comes to mind, Turkey and Tunisia, which are, in our view, the most vulnerable to changing global liquidity condition. I think in Turkey, the impact could be direct and through a lower rollover rate for the banking system external debt. Although if you look at the balance sheet of the Turkish banking system, it appears to have sufficient foreign currency denominated assets, but a large portion of these are placed with the central bank and with the government, which could reduce their usability in a worst case scenario. Now, in the case of Tunisia, the risk is more tied to the political transition in the country and its potential impact on the discussion with the IMF. In the absence of smooth transition and financial support from the multilateral, we think that the government could come under severe strain, which could have negative ramification on the overall economy and the banking system. The other country that comes to mind also is Qatar, because we have some concerns there on the speed and extent of the buildup of the banking system external debt. But there are some strong mitigating factors. For example, the fact that a portion of the non-resident deposit is relatively stable and has proven to be stable even through various episodes of stress, and also the strong government support in case of need.
Now, let's take a look at the global picture. Some analysts are warning that these aggressive rate hikes and the subsequent rate hikes may lead to a recession in the U.S., and this obviously has international implications. What are your thoughts on the potential for a recession?
Right. Currently, we do not expect a recession in the U.S. in the next 12 months. However, we recognize that the risks have increased. We have a qualitative assessment of recession risk over the next 12 months that we look at, and which is now at around 30% within a wider range of 25 to 30%. And in our view, recession risk increases in 2023 as successive rates hike take hold. And we have another augmented term spread indicator that we look at, which is a quantitative assessment of recession risk in the next 12 months. And this indicator is still in the single-digit territory.
Positive news. Thanks so much. Senior Director at S&P, Dr. Mohammed Damak.
Thank you for having me.